Morning, ladies and gentlemen. Welcome to the LIC Housing Finance Q4FY23 earnings conference call hosted by Axis Capital Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Praveen Agarwal from Axis Capital Limited. Thank you, and over to you, sir.
Thank you, Lizanne. Good morning, everyone, and welcome to this earnings call of LIC Housing Finance. We have with us the management team of LIC Housing, backed by Mr. Y. Vishwanath Gaur, MD and CEO, Mr. Ashwani Ghai, COO, and Mr. Sudipto Sil, CFO. I would request Mr. Vishwanath to share his initial remarks, post which we'll open the floor for Q&A. Over to you, sir.
Yeah. Good morning. Thank you, Praveen. Thank you. Very good morning to all of you. I extend a hearty welcome to every one of you to the post-earnings conference call of our LIC Housing Finance Limited. As you are aware, LIC HFL declared its Q4 FY23 results yesterday. During the year 22-23, we have seen significant movement in interest rate scenario due to increase in repo rates by RBI. In the April policy, RBI has signaled a pause, post which there have been some improvement in the interest rate scenario. Now, I would like to share the key financial highlights of the quarter, which are as follows. Total revenue from operations 6,415 crore as against 5,300 crore for the corresponding quarter of the previous year, with a growth rate of 21%. Outstanding loan portfolio stood at 2,75,047 crore as against 2,51,120 crore as on 31st March 22, reflecting a growth of 10%. The individual home loan portfolio stood at 2,28,730 crore as against 2,04,098 crore as on 31st March 22, and it is up by 12%. It is now comprising 83% of our total loan book. Total disbursements for the quarter were 16,027 crore as against 19,315 crore for Q4 FY22. Out of that, disbursement in the individual home loans were 12,406 crore as against 16,341 crore for Q4 FY22. Project loans were 1,554 crores as compared to 428 crore in Q4 of last year. On the net interest income front, the NII was 1,990.30 crore for the quarter as against 1,629.87 crore for Q4 of FY22, and it is showing a growth of 22%. Net interest margin for the quarter stood at 2.93% as against 2.64 for Q4 of FY22. Profit before tax, PBT, for the quarter stood at 1,444.78 crore as against 1,314.41 crore, showing a growth of 10%. Profit after tax for the quarter stood at 1180.28 crore as against 1118.64 crore for the same period of previous year, reflecting a growth of 5.5%. Dividend declared was 425%, that is 8.50 rupees per share. In terms of asset quality, the stage 3 exposure at default stood at 4.37% as against 4.64 as on 31st March 22 and 4.75 as on 31st December 22, reflecting a sequential improvement in the same. Total provisions as on 31/3/23 is 7,230.26 crore with stage 3 provisioning cover of 44%. During the quarter, we have written off loans to the tune of approximately 350 crore, taking the total write-off to around 540 crore for the full year. Going forward, the credit costs are also likely to be lower than past years. Also, with the continued focus on the recovery, the asset quality has become stable with an improving trend quarter over quarter, which has helped us in much better visibility. On the funding side, we have witnessed an increase in overall cost of funds by 111 basis points during last year, against reported increase of 250 basis points by RBI during the same period. Incremental cost of funds stood at 7.38% for the full year and 7.84% for the quarter. Net interest margins for the year stood at 2.41 as against 2.28, both year on year and also quarter over quarter. The improvement in spreads has been registered. During the most part of the year, the yields remained at elevated levels. However, in the past 1 month or so, we have witnessed reduction in the yields across tenors, especially at the longer end of the yield curve. This augurs very well for the company in terms of our total management of liability. In terms of asset pricing, we have passed on 210 basis points of rate hikes during the year and a further 25 basis points in April 23. In terms of business operations, on a full year basis, there has been a growth. Though asset growth was tempered due to successive hikes in interest rates impacting credit offtake, especially towards the second half of the year. With the greater stability in interest rates, we are confident of very good year ahead. Further, I would like to bring your attention to a large number of initiatives which have undertaken and proposed to be undertaken for the current year. We are also expanding our presence in the geographical areas across the country by opening our new offices across all our area offices. Then a specialized team has been formed for appraisal of high value cases at corporate office. Then implementation of SAP has been fully completed. We have also implemented a new core loan management system, LMS, to improve and smoothen the loan management process also. With all these initiatives, we are certain that the year will be far better than the earlier years. With this brief introduction, I would like to invite you for your queries. Thank you.
Thank you. Ladies and gentlemen, we will now begin with the question and answer session. Anyone wishing to ask a question may please press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, in order to ensure that the management is able to address questions from all participants in this conference, we request you to limit your questions to 2 for participant only. The first question is on the line of Vivek Ramakrishnan from DSP Mutual Fund. Please go ahead.
Hello, sir. This is Kunal from DSP Mutual Fund. So I just have 2 questions. First was on the retail disbursements, which is your individual housing loans. So we have seen 2 consecutive quarters of sequential decline. So is it just on the account of base effect, or are we seeing any real slowdown happening over there? And second question was on the NIM trajectory. So first thing is obviously, like you mentioned, that your long-term cost of funding has also come down, and you have also passed around 210 basis points of rate increases on your asset side. So what portion of your book has completely seen the impact of this rate resets, and how do you see your NIM panning out in the upcoming quarters? Yeah.
Okay. Actually, it's a very good question. As far as the disbursements are concerned, if you look at what happened, the book has, of course, the overall portfolio has gone up by more than 10%. I agree. Only thing is, in some pockets, the disbursements were not to the extent we expected actually. Others would have scored better there also. Even then, what happened, of course, what you say also has got some impact because the interest rate hike. In some pockets, actually, people that wait and watch more also was continuing. With that, what happened, the disbursement across, if you see some regions, especially 1 or 2 pockets, we could not see that much of what you call traction compared to other regions. Others, what happened, the base effect also earlier years was there. That also was reason because last year the rates were nearly almost at 200 basis points less than the current level. Especially in the affordable segment, that also would have taken some sort of hit. And with all these things put together, I think now what I can more or less the rates are stabilized. Now the visibility is very clear that in the days to come, the traction, even now we are already witnessing a very good improvement in every pocket. Even those areas which could not do earlier, now there also good traction is there. With that, we are very confident of actually very good progress in our disbursements in the individual home loan book. Regarding
Hi Kunal, regarding the margins, yes, as far as the asset side is concerned, we have effected one more rate hike, which is the WEF 1st of April 2023. So that is yet to get impacted because all the others were in the previous financial year. In this financial year, we have done 25 basis points, which will be coming in Q1.
Thank you, sir, and good luck.
Thank you. The next question is from the line of Avinash Singh from Emkay Global. Please go ahead.
Yeah, good morning. Thanks for the opportunity. So, first question is from what you said in Q3 call and taking it from there. So, two things have just sort of reversed. So, if I look at the stage 3 provisioning coverage ratio, you had increased it to 50% in Q3 and said that, okay, you'd like to be there. But again, you have lowered it to 44%. And the second, in that quarter also that, okay, you are kind of going slow towards a project finance disbursement is concerned. Again, in Q4, that has gone up. So, what has changed from Q3 to Q4 to sort of that made you change this stance on these two things? That's my question number one. And second, if you can just help me with slide 18, where you have disclosed the spread and NIMs. So if I see on the annual basis, the spread seems to have improved by almost like 50 basis points, but the NIMs improvement is just, 12-13 basis points. So what sort of why the is inconsistent? So these are my two questions. Thank you.
I will start with that query on the provision. Actually, if you look at it during the year, we have written off 540 crores. That in the opening statement we had mentioned. Now, if you add that 540 crores to the existing provisions on book, it will work out to almost 50%, 49 point something percent. So it is not to say that the provision cover has been reduced or something. There were some cases on which 100% provisioning was done, so they have been removed. So there is no change in stance per se. Number one. Number two was the query regarding the margins on a full year basis. On a full year basis
project finance disbursement also, that has accelerated in Q4.
As for the project finance concerned, you see what happened, we too were selective. Even earlier also in the beginning of the year also we were targeting that the year before, that is 21-22, we could not do well. Of course, their small uptick was there. But last year what happened, actually on selective basis we have done very well, both in terms of our construction finance and line of credit items and all. So there was a good improvement in that book. That also one thing which added to our portfolio, and it is very healthy portfolio added to that.
And that is actually probably the number is appearing inflated because of the base effect. A year before that, there was hardly any disbursement.
Correct.
Even now after the disbursements of third quarter or fourth quarter, if you see the overall composition to the book is hardly 3 or 4%. The second point is pertaining to the margins. Margins at the beginning of this year, in the first quarter call, I think we had very clearly said on a full year basis, we will certainly improve. If you see in one of the quarters, that was second quarter, there was a abnormal dip in the margins which fell down to 1.8. Even that point in time also, we were very confident and we maintained the outlook on a full year basis we'll recover. Now you kindly compare the second half margins with the second half margins of previous year, and then really you will find that there has been significant improvement.
Okay. So I was more kind of looking at if the numbers on your slide, that is spreads and margin, if they are indeed for the full year, then the gap for FY22 is close to 40 basis points as far as the NIM versus spread concerned.
In fact, if you see, again I'm just repeating, second quarter we had some reversals on the income side, which you will find details of in the con call transcript.
Okay.
It is because of those reversals which have happened in the second quarter, it has depressed.
Correct.
That is the reason why I'm saying that if you compare the second half with the second half, then actually you will get to see the real
even earlier our guidance was more or less 2.4 to 2.5%.
On a full year basis.
Yes. Full year basis, that is our
that guidance we had held right from the beginning of the year.
Yes, that is always held up.
Okay. And any reason for sort of a bit
sorry
of
to interrupt, Mr. Singh. Maybe request that you return to the question.
Sure. Okay, thank you.
Thank you. The next question is from the line of Gaurav Kochar from Mirae Asset. Please go ahead.
Yeah, hi, good morning, team. Congrats on the quarter and thanks for taking my question. I have three questions. So firstly, on this margin expansion, just to clarify, there are no one-offs, right? This is the 0.93 we have reported does not have any one-off.
There are no one-offs. No one-offs.
Sure. Great. So, sir, from an ongoing basis, let's say taking FY24 full year, the reported margins for FY23 was 2.41, and if I remove the impact of that second quarter, what I think Sudipto alluded to in the previous question, there was a reversal of 275 crore because of fixed to floating conversion. If I remove that, the NIM broadly 2.55 is the full year NIM for FY23. Now going ahead, given that we have exited the quarter at 2.93, the cost of fund, if I look at it at 7.63 on the portfolio versus incremental is 7.8. So I mean there should not be any material increase in cost of funds from here on. On the other hand, full year the full benefit of yield will come in this year because the yield improvement whatever we took were more back ended. So taking those cues and given that the margins at 2.9 probably would settle at 2.6, 2.7 on a steady state basis. So for the full year 24, any sort of guidance you'd like to give, or maybe is it reasonable to expect a 2.6, 2.7 margins for full year FY24? That was the first question.
Yeah, I think we'll not put the word guidance, but certainly going by the numbers, 2.5 at the base certainly looks achievable at the base.
Okay, so 2.55 is what you did in the previous year.
Yeah.
And
yes.
going by, and that year was marred with a lot of challenges on cost of funds.
Correct.
So, is it reasonable to expect some improvement from that level?
Yes.
Certainly. It is, and we are also positive on the improvement in the margins. Ahead of 2.5 minimum.
Yeah, and given that 2.93 does not have any one-off that you have delivered, I mean, some rub-off of that will also translate in the next few quarters.
Generally, that happens.
Sure. So the second question is with respect to the stage 2. So there has been an increase of almost 130 bips in stage 2. Just wanted to understand, is it due to restructured book which is coming out of moratorium and now probably starting to fall in the overdue bucket? Is that the reason or there is some other reason?
No, restructured book earlier also was the same only. No, there was no change in that one. Now what you call now by end of June, everything will be getting over, more or less.
Okay, then why has there been a jump in stage 2 asset? Stage 2 asset has gone up to 5.25 from 3.9 in the previous quarter. What is the reason behind that, sir?
And mostly what actually we were looking into that, here and there what we could find is that because of the increase in EMI, some increment now because of rate increases, EMI also increased across. Yeah. So what happened now when these NACH payments are hitting here and there, probably what we noticed is that the amounts are not fully adequate enough to get it. That's why instead of stage 1, they are slightly come to stage 2. But now efforts are fully on. What happened now, it has been, once again, we are looking at the system. So now recovery is kept in place. So with that, again, they move back to stage 1. That's quite going to happen. I think 10% or to even 20% effort will be there on that, which are switched over to this. And we are confident that in this quarter, this effect will not be there. Mostly.
Okay. So you are saying that's one
more of a technical impact, and that has now been addressed.
Okay, so maybe in the June quarter, this number will move back to the December quarter.
If you see steady state basis, it has never been this number. This number has never been in this level on a steady state basis. I mean, even during COVID period. Yeah. Okay. So this is more of a technical glitch.
Okay, so large part of this will be pulled back by the next quarter.
Yes, certainly.
Okay, great. And
accounts are all paying accounts, huh? There are no delinquent. They are all paying accounts.
All regular accounts only.
They are regular and paying accounts.
Okay, got it. And sir, just to clarify on the credit cost, the earlier participant asked, the stage 3 cover is 44%. So going forward, we should look at stage 3 PCR to be maintained at this 40-45% level, or this will be inched up to 50% going forward. If there are no write-offs, would you like to increase it to 50, or this is what you maintain, 40-45% PCR on the stage 3?
I think we look at this matter from the credit cost point of view. Credit cost point of view, it is likely to be in the range of around 45-50 basis points.
Correct.
And it will be probably across all the stages as and when required to create more balance.
Okay. So you maintain 45-50 basis point credit cost for full year FY24.
Yes.
And moreover, now resolutions for all the cases also we are seeing something positive, so that probably this year there will be some good number of resolutions also, so that something will definitely, asset quality will improve also.
Okay, seeing on the developer side?
Developer side also actually efforts are on there to to reduce the NPAs. I think some good, at least 4 or 5 good resolutions are being worked out.
Pipeline in the NCLT.
Yeah, they are having pipeline. NCLT almost 2,000 crores also is in NCLT almost.
Okay. So any number, I mean, quantum of resolutions that you expect in this year broadly?
This year, out of the things, I think at least 400 to 500 crores minimum we are expecting.
Okay, 400 to 500 crore recovery in this year. Sure. And sir, just last question on the disbursement side again. I think one of the participants earlier also asked the disbursement had slowed down. So do you see any pickup in FY24, and if any target that you would like to give for full year FY24 now that interest rates have stabilized?
Correct. No, this is only a setback for some parts of the actually our regions, not across India. But what happened, some pockets we could not do very well due to some regions there. Otherwise, for the whole of this current year, that is FY24, we are certain that our growth rates will be in the individual home loan book should be at least minimum of 12 to 15% going ahead. Then overall we can show a growth rate of 10 to 12%. That's what we're looking at. And according to the targets also worked out. And book growth will be very healthy this year.
So 10 to 12% disbursement growth is what you're saying?
Yeah, in the individual home loan book, we are minimum expecting around 12% to 15% range.
Sorry, this is AUM or disbursement, sir? Just to clarify.
Disbursement.
Okay, disbursement showing 12 to 15% growth on individual loan book.
And overall book also now already we are going at 10%. That will be better than 10%. At least it should go to 12% at least.
Okay. Got it, sir. And on project loans, sir, this quarter we did some disbursals. So this run rate will continue 3-4% of total.
Our loan book now, project finance is consisting around 3 to 4% only. And there is slightly small uptick maybe there, not very, a great growth rate will be there. But anyhow, we are also very selective basis. We are actually dispersing loans and also selecting the good clients and good projects for our construction finance.
Sure. Thank you so much, sir. Thanks for asking all the questions. Thanks.
Thank you. The next question is on the line of Umang Shah from Kotak Mutual Fund. Please go ahead.
Yeah, good morning, and thanks for taking my question. 2 questions that I have. One is just recalling our commentary in the second quarter conference call where we did indicate that there were some competitive pressures and due to which we had to kind of restrict pass on in terms of transmission of rates, right? If we now look at the current situation, clearly the competitive intensity doesn't seem to have stopped, and visibly the demand appears to be lower, which is reflecting into our disbursement growth as well. In this scenario, what gives us the confidence that we would be able to hold on to our yields or margins, and there will be no pressure on us to kind of further probably lower our yields or probably lower our growth aspirations?
As far as the disbursement is concerned, of course, one thing is this year also overall growth in the book is around 10% across, and then in the individual home loan also 12% is there. What confidence actually, we are very confident that as far as disbursements are concerned, mainly in the individual home loan book, because now the rates are almost stabilized. We are also now everywhere, we also now implemented new systems. What we have done is now earlier to maintain a very good, to improve our TAT actually, we have we implemented a very good system of supporting even grassroots level people And we also have now implemented SAP, and also we implemented a very good software also, where as I told you already, our loan management system is now being improved with the new software. With all these things, actually, even we are also increasing our penetration outreach by opening new offices also across all the geographies. So these things anyhow will give us a cushion that the growth rate what we're expecting minimum has to come from there only, and it will come also. So with all these things in place, we are very sure that as far as the book size is concerned, we will grow at a very healthy rate of around 12 to 15%, as I told you already. Then asset quality wise, if you look at what happened now, because of good efforts made so far, apart from the Indian home loan, even other loans also were able to show good progress, and very good resolutions are in place. With that, I think in the next 2-3 quarters at least, we can witness a very good improvement in asset quality also. So with these things, we are very sure that all our promises like our NIMs as well as the margins will certainly maintain.
If I can just add, just one more thing is that if you look at the prepayment rate, that has actually come down. So that is indicative of a different competitive intensity as what it was seen in the last maybe 2 years or so.
Mm-hmm. Right. My second question is again pertaining to margins, right? I mean, not looking at the current quarter margins, but if I look at last 5 years, margins typically have been in a band, and although while we appreciate that on a full year basis we have delivered the margins that we were looking at, the margin volatility on a quarterly basis in last 2 years particularly has increased significantly. So just wanted to understand that fundamentally, has there been any change into our business which is leading to this sort of a quarterly margin volatility? Because in the past also we have remained in the band of about 230 to 40 basis points of margins, but the quarterly volatility wasn't so high.
As far as the quarterly volatility is concerned, if you see the exit margins of any financial year has always been on the highest amongst the 4 quarters. So that I would attribute it to be a usual phenomena which has been there for several years. So that is one thing. Second thing, if you look at it on a full year basis, there has been stability, and barring last financial year, barring 21-22, it has been more or less increasing by few basis points. In 22-23, we had indicated that it will be on a full year basis much better than what we had seen in the whole of 21-22, and it has come out that way. So going forward, you will see some stability in the margins, and we have indicated also the band in which it is likely to be there. So stability will certainly be there.
And one more thing, earlier 1 or 2 quarters, what happened, there was a delay in transmission of the rate hikes. That probably also would have affected that margins only. But going forward now, I think the visibility is very clear. I think such volatility, I think not at all will not be there at all. We are very much confident of that.
Sure. And so just one last question, if I can squeeze in. At what frequency do we kind of relook or revise our PD LGD assumptions, given the fact that across buckets our provision coverage ratio, be it stage 1, 2 or 3, has been again a bit too volatile. And I'm not looking at the 4th quarter numbers. I'm looking at probably a much longer frame, maybe about 2 to 3 years. So just wanted to understand at what frequency do we change our assumptions?
See, it is actually a dynamic model on a rolling basis. Every quarter when we sit down to draw the numbers, it is on the past 120 quarters, 120 months. That is 10 years.
The historical, our own performance.
So, for example, when we sit for, say, March, then it will be the previous 120 months. When we sit for June, it will be the previous 120 months from June backwards, just like that. So it's on a rolling basis. So you can say, in effect, it gets reviewed every quarter.
But Sudipta, something as standard, something like a stage 1 provision, right? Standard asset provision. Typically, in that line also, we have seen a bit of a volatility, right? I mean,
that is precisely what I'm saying now. Now we have ensured that there is, earlier it was completely, I would say, a very objective model. Now management overlays are also there, which ensures this we get to see from this quarter onwards. We have already started seeing that from stage 1, etc. also we have created sufficient buffer to ensure that there is no such volatility, even if one particular account moves from one bucket to another.
All right. Okay. Thank you so much and good luck for future quarters. Thanks.
Thank you. Thank you. So nice.
Thank you. The next question is on the line of Harshvardhan from Bandhan AMC. Please go ahead.
Hi, sir. Thanks for the opportunity. Just a couple of questions. Wanted to understand the CET1 ratio as of March 23.
What is that?
Can you please speak a little loudly?
Sorry to interrupt, Mr. Harshvardhan. Sir, we are not able to hear you clearly.
I want to understand the CET1 ratio for the financial year.
So for the financial year, it is yesterday only numbers have come, so we'll have to first report it to the regulator. But it is right now expected to be in the range of around 16 to 17%, and the total capital adequacy will be 18 plus.
Sure. Thanks. And sir, what would be NHB allocation for the financial year? The total disbursement that we got from NHB?
For which 23-24 or 20-23?
22-23.
Last financial year around say 5,000 crores we have taken from NHB.
And we expect a similar amount to come this year also?
Slightly more possibly.
And sir, just one last question on our incremental cost of funds. You mentioned that we are in quarter 4 we raised somewhere at around 7.8.
Yeah.
What would be the rate of say in quarter 1? Is it around that number or it has further inched up?
Q1 of this, current 23-24 Q1.
Yes, sir.
It has come down by around 25 basis points.
Okay, our incremental cost has come down.
Yeah, around 20 basis points you can say.
Sure. Great. Thanks a lot, sir. Thanks.
Thank you. The next question is from the line of Abhijit Tibrewal from Motilal Oswal. Please go ahead.
Yeah, thank you for taking my questions. Good afternoon, everyone. Sir, obviously we kind of continue to surprise us, and the good thing is that this time around we have a pleasant surprise on margins and credit cost asset quality. And while we have, largely answered all the questions, just wanted to understand that when we said there are no one-offs in the margins of 2.93% that we reported. Sir, just wanted to understand, given that we follow a quarterly reset on the first day of every quarter, how is it that the computed yields, typically what we compute using the interest income number that you report, are expanded by close to 60 basis points on a QQ basis? That's the first question that I kind of wanted to understand. And the other thing is, sir, maybe when we look at your disbursements in this quarter, I think maybe you were the first corporate, even last quarter, to acknowledge that there is some sentimental moderation that we are seeing on the demand front, particularly in the higher ticket size segment. So this quarter, you could have chosen to deliver a slightly higher growth rather than deliver such high margins. So what is your thought there? And secondly, sir, we have kind of acknowledged that going forward, developer finance will start maybe increasing a little bit from here. Just wanted to understand, for a product segment where we last reported 45% kind of NPAs, what is the rationale of again growing that book?
As far as the project finance is concerned, what happened, of course, as I told you earlier, also we are very selective basis, we are giving in some pockets where our own known customers who are having very good experience with us, number one. And that book also we have to look into that because, as you know, that books offer some sort of better margin for us. That is it. Then your second question was about the disbursements and all, I agree. What happened actually, I told same thing. What happened, we are also, at that time, demand also was very good. We could see that the substantial increase in the demand also, improvement sentiments and all. Actually, the performance across India, if you measure, what happened, one or two regions could not do very well. That's why the numbers are not that much, comparable, or we could not do very well overall. Or else in other pockets, we have shown excellent growth. The demand is fully utilized, the demand is fully met. That's why we are very confident that in the days to come, even this current year, the disbursement certainly will be, as I promised you, that will be around, in the individual home loan book, at least should be in the range of 12 to 15%.
Yeah, you had a query on NIMs, Abhijit? Can you kindly repeat?
Yes, sir.
So what I wanted to understand is you have acknowledged that there are no one-offs in the margin.
I got you. I remember. See, actually, it is very simple. You can actually add back. If you look at the fact that we have increased by 35 basis points, which is effective from 1st of January itself on the entire book of almost 2,70,000 or 2,60,000 crores, plus the incremental disbursement which we have done. You remember that we have also increased on our incremental pricing from January. That also, if you see the incremental net, I would say addition to the assets, I think you will be able to come very close to the figure of the current quarter's interest income.
And more
there are certain lags also, certain portfolios because of NPLs, etc., could have not been impacted in the previous quarter. They have come in this quarter. There is an improvement in the NPLs also. So that way you can, I think, very easily reconcile. There is no one-offs in the current quarter as far as the interest income is concerned.
And one more input on your disbursement point. What happened, of course, as I mentioned earlier, also the partly the base effect also was there because the year 21-22 was, if you compare to that. Then secondly, of course, rate hike. That also is partly attributable in some pockets of our geographical locations. Then in the project finance or construction finance, if you ask me, nowadays we are focusing on even some LRDs and again some sort of line of credits. So what happened there, the margins we are able to pick up.
And there the risk is much less as compared to a core construction finance.
Got it, sir. So this is useful. And maybe one last data keeping question. If you have already shared it in the presentation, I can look it up. But you used to share your stage 3 numbers for IHL, NHC, NHI and project loans.
Yeah, I can share with you. Just bear with me for a second. As far as the stage 3 numbers for IHL, it is 1.6%. Then for NHI, that is 6.6%. NHC is 22%. And project it is 40%. And I would just like to add here that in each of these 4 categories, it is reduction from the December numbers.
Got it. So which means that, I mean, at least in your stage 3, there has been some resolutions or upgrades that you've seen?
Yes.
Because what you were explaining, right?
Stage 3 across, we have collected more than 500 crores in the NPA accounts itself, which includes both the principal and interest.
Good resolution were there actually.
Got it. And so this 540 crores of write-offs in FY23, what was the write-off number in Q4?
The Q4 number was 352 approximately. Plus the one that we had done in, I think, Q2 was 191.
Yes, Q2.
So put together is 540 crores.
Got it, sir. This is very useful, sir. Thank you so much and wish you and your team the very best.
Thank you.
Thank you.
Thank you. The next question is on the line of Kunal Shah from Citigroup. Please go ahead.
Yeah. So first, in terms of the proportion of the customers wherein there would have been the EMI increase versus the tenor increase, if you can just highlight that maybe with the pass on in the rates, so that would be helpful.
3%. So total about, say, number-wise, it will be around, around 12,000 customers.
1%.
Which is about, per customer number-wise, it is less than 1% of the total outstanding number of live loans.
Correct.
Live loans is around 15 lakhs. So it is less than 1%.
Wherein there would have been the increase in EMI.
Yes. 13,000 is the number if you
Correct.
more
13,000.
13,000.
Okay. And in absolute term, if you have to look at it in terms of the exposure?
Exposure-wise, it will be closer to around, say, 2,000 to 3,000 crores.
Average ticket size?
Average ticket size will be around 30 lakhs.
25 to 25.
30 lakhs.
Okay. No, because the way you highlighted in terms of this increase in stage 2, maybe a part of it is because of this.
It is exactly what we said in our opening remarks also. If you actually see this, so it is not that these accounts are not paying. but the full EMI has not been recovered because of some technical matters. Now we have addressed the issue. So now onwards, this will not be recurring.
Okay, because that delta was almost like 1.3, 1.4%. So,
yes, so which actually is that 1.1% in terms of the number of accounts also as a percentage of our total live loans.
1.1%.
Okay, got that. And secondly, maybe with respect to the growth, so you mentioned in terms of the prepayment rates actually coming off, but maybe because of the competitive intensity, is it that also which is leading to relatively lower disbursement growth, particularly in 4Q? Otherwise, generally, seasonally, 4Q is quite strong for us. So was it merely on account of rate compared to the competitors, or how is it?
No, it is not the rate per se. Actually, if you look at it, interest rates have been going up in the system for the last 3 quarters, right from the month of June onwards up to February. And every time there has been an increase in rates, so what actually happens is that if the interest rate of the home loans or any finance product increases very sharply within a very small space of time, then it is sometimes pushing the customers into a deferment mode. It is not that the person has cancelled the decision to purchase. It is just a deferment, maybe for 1 quarter, maybe for 2 quarters. But actually, if you see now, the interest rate trajectory looks like it has peaked. And we have already seen that impact on the bond yields, which has come down by 30-40 basis points at least. So taking that cue, it is likely that going forward, interest rate stability will be there. And the customers have already shown indications that they have come back to the market. The other thing is that on the real estate side, you have seen price points moving up, which is also a positive factor, which actually gives you an indication that demand is picking up.
No, absolutely. So compared, but still in terms of the market share, it seems to be a loss. So maybe
no, it is not a loss. If you see, it is not a loss because if you see up to the third quarter, we were clocking home loan growth of around 15%. And if you actually see the data in terms of housing finance sector growth, till I think November or December, it was not growing more than 15%. It was more or less in that range.
No, particularly for this quarter, 4Q.
I don't think 1 quarter gives any indication of any market share loss.
And it is only here and there, some what you call not across, even some regions have done even far better than it. Some regions growth rates are more than even 30% of.
And on a quarterly base of say 15,000 crores, even 1,000 crores extra business would have translated to a much higher number in terms of real numbers.
Correct.
So if you look at it per se, then it is not that there has been any drastic reduction or drastic decline in the disbursement.
And moreover, what happened to address it even more significantly, we have also expanded our reach. As I told you that our new expansion of the branches across all the regions, that also will give us more footprints across so that we will show good growth in all regions this year.
Okay, yeah. Thank you and all the best. Yeah.
Thank you. The next question is from the line of Nischint Chawathe from Kotak Institutional Equities. Please go ahead.
Yeah. Thanks for taking my question. Can you sort of highlight, which segments have seen maximum write-offs this year?
Can you repeat the last part of your question?
Yeah, the write-off has been in which?
Write-off we have done in the there are 3 categories of assets, as you know. IHL, the individual home loans, and there the write-off has been around 200 crores. In the non-housing corporate, which includes the project loans, there the write-off has been around little more than 300 crores. And in the non-housing individual, the write-off has been around 30 crores. Totally around 530 crores.
Sure. Yeah, sure. You mentioned that your incremental cost of borrowing is 7.84, which is probably coming down maybe 20 basis points or so in this quarter. What would be the incremental lending rate?
Incremental lending rate, the lowest rate is 8.6% today for the highest rated CIBIL score.
I mean, 8.6 as quoted, right? So the IRR could be a little higher.
Yeah, IRR will be higher, plus it is at the premium segment in terms of CIBIL score.
And you have raised 25 basis points across the board, is it? Or, even for new customers from this quarter or this?
No, not for new customers. It is on the PLR. from 1st April.
Sure. So basically, I think what we are trying to say is that probably 8.6 is what is your incremental, what you're saying is the incremental lending rate.
No, it is not. 8.6 is not the IRR.
Okay, 8.8 or something like that, and as against that, you will probably have an incremental cost.
That is for the best customer, and only for the individual home loans.
And your incremental rate for on the book would be how much? Sorry, as in the disbursements would be how much?
Sorry?
Incremental rate on the entire block of disbursements on the individual side would be how much?
But including all types of assets, all types of credit scores
I need
put
to say
together.
that the best customer gets 8.6.
Yeah, it goes up to 9.1. So 9.1 means that if you annualize it, it will be around 9.3.
Got it. 9.3 and 9.3 versus your incremental cost of around 7.6 or so.
Yeah, that is only on the individual.
But which is a healthy spread, right? So when you are giving a margin guidance of 2.5, I'm just trying to say that probably you are kind of maybe building in some sort of a decline in yield or compression in yield.
It is not that way. If you see last year also, we were very clear that there will be an improvement on a year-on-year basis. This year also, we have indicated there will be an improvement on a year-on-year basis. And obviously, the numbers are, whatever you have seen in terms of cost of funds and lending rates.
Sure. Got it. Thank you very much.
Right. Thank you.
Thank you. The next question is from the line of Bhavik Dave from Nippon India Mutual Fund. Please go ahead. Sorry to interrupt, Mr. Dave, we are not able to hear you. There's a lot of disturbance from your line.
Is it better?
Yeah, it is clear.
Yes, sir. Please go ahead.
Yeah. Sorry. Most of my questions have been answered. One question is on the over the last 1.5 years, we've been seeing increasing dependence on banks versus NCDs that we used to have. I just want to understand why has that happened, and because the cost of funding for banks is reasonably higher versus NCDs, and with now HDFC Limited going out of the market, AAA entities like us should benefit from the NCD market, and that's the understanding we have. Just want to understand, can this mix shift back in terms of NCDs versus banks, given the way it's happened over the last 1.5 years? Can that reverse in FY24? Is that a fair assumption?
We are not able to hear you clearly, but I just got the understanding of what you are trying to query. See, this is part of an overall diversification plan. There was some 5 years back, there was a huge dependence on the wholesale debt market to the extent of 80%. Number one. Number two is, if you see the asset profile, 90% of the assets are in the floating rate side. And our exposure in our funding was almost 80% on the fixed side. So in a declining interest rate scenario, our spreads were getting severely compressed. So one of the reasons why we wanted to diversify was to reduce the dependence on any market segment. So now it is well diversified. We are not dependent on any market segment. Number two, it is a natural hedge that we are building into the balance sheet. We have got 90% plus of assets on the floating side. Now we have got a decent amount of liabilities also in the floating side, which will come to our help significantly when the rate cycle reverses, and we are sure that the rate cycle will reverse maybe in the next 6 months, maybe in the next 12 months, maybe in the next 18 months. So it is a part of a well thought out strategy. It is nothing to do per se only with the cost of funds. If you've seen many of the occasions, the banks were offering significantly lower because of the liquidity that they were holding with them, and they were not able to lend to other segments. So this keeps on shifting, but it is a well thought out strategy, and it is designed to insulate the balance sheet from two large risks. One is a concentration risk in terms of sourcing of funds from any one particular source, and the second one is to diversify and mitigate against the interest rate risk.
And the bank funding will be at 1 year MCLR, right? Majority of it?
No. It is a combination of linked to repo rate. It is a combination of external benchmark like T-bills as well as MCLR, where we are generally marking with the 3-month MCLR. There also we have interest hedged. So any one of the benchmark moves, we will get a benefit.
Perfect. Very, very useful. Thank you so much.
Thank you.
Thank you. The next question is from the line of Piran Engineer from CLSA. Please go ahead.
Yeah, hi. Congrats on the quarter and thanks for taking my question. So my first question is on basically how much of your loan book is still under moratorium, which is the restructuring 2.0 wala moratorium.
Yeah.
Yeah, now I think it is around 748 crores. No, that's the only thing.
748 crores is yet to come out of moratorium now. All others have come out.
Okay. And out of we had restructured, I think, around 7,200 or so.
Yeah.
If you can just break up now, 748 is still in moratorium, so the remaining, say, 6,500 crores, how much of that would have moved to stage 1, how much to stage 2, and how much to stage 3? Just a bifurcation of whatever has come out of restructuring.
Yeah, I got your point. Out of around 7,000 odd crores which have been implemented, about 1,000 crores account have been closed. So fully repaid and closed, 968 or 1,000 crores. 748 crores is yet to come out of the moratorium, and out of them the NPA is around 1,500 crores.
And stage 2, sir?
Stage 2, everything else we have kept them in stage 2, irrespective of the fact whether they are stage 1 or stage 2. We have kept all of them in stage 2 as a part of prudence.
So they are all provided for, not entire.
And we have provided for also them.
Oh, so almost 4,000 crores roughly will be in stage 2 out of it.
Yeah, irrespective of the fact that some of them are actually fully regular. But still we have, as a matter of caution, placed them in stage 2 so that we are able to provide higher provisioning rate.
And what is the rule from either your own board or RBI that if they pay, let's say, for 12 months regularly or 24 months regularly, they get upgraded, or they never get upgraded throughout their life?
No, they will certainly get upgraded. See, obviously, if the loan gets closed, if the provision gets released, so it is an obvious interpretation. Secondly, if it is there for 1 year standard, then also it comes out of this provisioning requirement.
Waiting period
of 1 year from the point it actually comes out of the moratorium.
Correct.
Okay, got it.
12 months.
Okay, that's very clear. Second question is, our project disbursements of 1,500 crores, how much of that would be to existing projects where we already have lent to the lender, and how much are brand new projects?
I will not say brand new project per se, because in that 1,500 crores we have also lent to our line of credit also. So that line of credit is, it's not project finance per se. And balance mostly is to existing customers.
Maybe customers will be around 60% more or less.
60% of the balance. So maybe fresh customers, maybe hardly 100 or 200 crores.
Okay, that's it. And line of credit would be how much out of the 1,500?
Line of credit around 700 odd crores.
And this is to the corporate, not to the project, correct?
No, line of credit is to housing finance companies.
Housing company, HFCs.
So HFCs you all have given?
Yeah.
Okay. And sir, lastly,
for onward lending.
I'm sorry?
For onward lending.
For onward. And okay, makes sense. And lastly, sir, what is your LCR today?
LCR is around average for the quarter of March, 147. 140 plus.
Got it. Okay, that answers all my questions. Thank you and all the very best.
Thank you.
Thank you. The next question is from the line of Ankit Agarwal from Yellowstone Equity. Please go ahead.
Hello. Yeah, my questions have been answered. Thank you.
Okay, fine. Thank you.
Thank you. We'll move on to the next question. That is from the line of Renish from ICICI. Please go ahead.
Yeah, hi sir. Just one question per side. So in your opening remarks, you did mention about some of the pockets, not seeing the good disbursement demand. So if you can just give some more color on which geography, which pockets are seeing stress in terms of the credit optics.
Mostly what happened, if you look at our traction, actually traction was good across regions like South, then again to some extent Central and proper here. Then again, only thing is we could not see much traction mainly in North and to some extent in East also.
So any specific states or districts or,
It's not states. Whatever metros are doing well, but only some sort of what you call tier 2 cities. They could not get good traction because mostly we operate in the salary structure, in the sense 80% of business comes from the salary segment. So because of this rate increase and all have taken a small hit there.
If I go by the presentation wherein 60% comes from metro and 40% comes from the non-metro. So basically, you are saying the non-metro piece not at pan-India level, but maybe some pockets are seen to be lower kind of thing.
Small hit, not a very big dent. It's minor. Yes.
Okay. And sorry, sir, just again, on the NIM side. So our exit quarter NIM at 2.93, and the kind of commentary or the highlights we have given in terms of the incremental cost of borrowing and the lending yields. First half 24, you expect NIM to sustain at this level of 2.9, or how one should look at? First half perspective.
No, it is. It cannot be compared with an exit NIM of any year. That is something we have discussed. Just few minutes back. Exit NIMs are always on the higher side, but on a full year basis, it will be better than last year. Full year of last year, and if you look at it, even on a first half basis also, the first half will be better than first half of last year.
Right, but practically your exit NIM should have captured all the rate hikes on the both the sides. Asset liability. So I was just wondering why that should not extrapolate to first half 24.
Part of it gets extrapolated, but if you look at it, there will be in some pockets of business, it may not have got fully translated. So that might come with a lag. There is always a lagged impact in both the sides, increase or decrease.
Okay.
And there is a possibility that towards the end of the financial year, one could also see a rate decline in terms of a rate cut from the RBI. But that will happen only in the fourth quarter, towards the end of the year.
Got it. So ideally, one should go by 2.55 the base NIM what you have said.
Base. That will be base.
Okay. That is from my side. Thank you.
Thank you. The next question is from the line of Sanket Chheda from DAM Capital. Please go ahead.
Yeah, hi sir. So my question was on again the increase in the stage 2 for this quarter, where we said that there was a technical thing wherein few NASH got bounced. So then my question is that once say it bounces for such technical reason, maybe it appears in bounce rates or maybe 1+ DPD, but usually gets resolved in say 10-15 days. For it to appear in stage 2, it has crossed 30+ DPD. So is there any action which was not taken in 30 days and you follow up only after that, or how to read that?
No, it is not that no action has been taken, but we have been able to address it to a significant extent. These are very technical matters, takes time, but it is now more or less, I would say, in Q1, you will not see this happening. That has now been fully addressed.
And more of due dates will be spread across, entire.
Due dates might be spread across
entire month, not in one day.
Okay. And on ECL provisioning, we said that we have created buffers, but on stage 1, we have just reached about 26-27 basis. Isn't that a regulatory requirement, or you think it's a buffer on stage 2 and stage 1?
No, I'm not able to understand. If you kindly can explain it.
So there has been reclassification from say stage 3 provisions to stage 2 and stage 1 this quarter. We saw quite sharp jump in stage 1 provisions also. So from say 5 bips to say 26-27 bips. So wasn't that necessary rather than as a measure of buffer?
No, there is no regulatory intervention as far as the index is concerned. Index is purely a model-driven. It is kindly a model-driven output. But this was something we had voluntarily done because we felt that the stage 1 provisioning is very less at around 4 basis points or 3 basis points. So from there we have increased it. It is to ensure that there is a buffer.
Isn't there a provision in, say, upper layer NBFC?
No. There is nothing of that sort for Ind AS.
Okay.
Ind AS, there is no regulatory mandate. Ind AS means it's a model which is based upon PD and LGD, which is the ECL. It is the expected credit loss.
I'm not talking about Ind AS, sir. I'm talking about the scale-based regulations which are.
No, there is nothing of that. There is nothing.
Only our own potential will keep.
There is nothing.
Okay, so we maintain that it's a buffer.
Yes, certainly.
Okay. Sure, sir. Those were my questions. Thank you.
Thank you.
Thank you. Ladies and gentlemen, we'll be taking the last question. That is from the line of Bhaskar Basu from Jefferies. Please go ahead.
Yeah, thanks. I just had one clarification around the restructured book. So, I think the restructured book under moratorium was about 1,400 crores last quarter and about 740 is now. Was the entire 1,400 crores already sitting in stage 2, or the part of the book which has come out of moratorium now moves to stage 2? Is the movement in stage 2 anything to do with the movement in restructured book?
No. They were already in stage 2.
The entire book was already in stage 2.
Yes. That we had clarified, I think, in a last quarter before that, we had moved all these OTR accounts to stage 2.
Okay. And secondly, just harping back on the yield question. So basically, when we look at the portfolio spreads exit, there has been a 33 bips of increase on a sequential basis versus, say, the calculated increase of about 60 bips. Was there any additional income recognition because of recoveries or some accounts getting resolved, etc. in this quarter?
No, there was no one-offs.
Okay. Thanks. That's all from my side.
Thank you, sir.
Thank you.
Yeah.
Thank you. Ladies and gentlemen, that was the last question. I now hand the conference over to the management for the closing comments.
So I thank every one of you for this arrangement of the analyst call. And wish you all the best. Very promising and also very performing the year ahead, 23-24. Wish you all the best. Thank you once again.
Thank you, members of the management team. Ladies and gentlemen, on behalf of Axis Capital Limited, that concludes this conference call. We thank you for joining us, and you may now disconnect your lines. Thank you.
Thank you, Praveen. Thank you, ma'am.
Thank you.